Welcome to our High Rock monthly video for June. My name is Scott Tomlinson, and with me on the call is Paul Tepsich, the founder of High Rock. And as well with us today is Diane Lucky, our senior client service representative. So lots of stuff to talk about today. So let's first talk a little bit about what happened in May. From an equity perspective, not a whole lot, although one thing we should make clear is that U.S. equities have been actually underperforming the global equity market. Canadian equities definitely doing better. Canadian preferred's doing okay. Canadian REITs and even bonds were pretty flat on the month. The gold and silver trade was the best performer. Paul, anything you want to comment on this slide?
Well, I would just make a note for our listeners that these are just prices only. So in some cases that doesn't matter, like gold and silver, but for bonds and most equities and certainly preferred shares, they do pay dividends or interest income. So that would be added on top for the month. So just keep that in mind. But away from that, as you can see, in the red and light blue, U.S. equities, Canadian equities, and global equities too, to a certain degree. The month of, mid-month, they were down at a reasonable pace, and then rallied back into the end of the month. So decent month across the board, I'd say. That's about it.
Yep. And the factor of the Canadian dollar strength, that's another thing we've been monitoring recently, and we'll look at how that's impacted the year. But again, Canadian dollar strength over the course of the month, it does negatively impact our exposure to to global equities, certainly to the U.S. equity market as well. And here's just how that looks. If we look at a S&P 500 ETF in US dollars, you can see that on the month it was up a little over a half, almost 3/4. But that actually entails the last couple of days as well. But from a Canadian dollar perspective, the S&P 500 actually was down about 1.25%. So you can see the impact that the Canadian dollar does have, especially on our US equity holdings.
Yeah, Scott, I would just add there too, that's roughly 2% strengthening in the Canadian dollar. So if you're a High Rock client and you have roughly 20% of your portfolio priced in US dollars, either in cash or US dollar securities, that 20% of 2% is roughly 0.4%. So our portfolios were negatively impacted by about 0.4% across the month, just because of the move in the Canadian dollar's strength.
This actually might be a good time just to quickly sort of refresh clients as to why we have exposure to US dollars. And I think for the most part, it is to help us mitigate risk. Certainly when we had the meltdown in March of 2020, that strength of the US dollar and the weakness in the Canadian dollar through that period definitely helped mitigate the downside, and that is something that we're always looking at as part of our risk management, right?
Yeah, and besides, we want to be invested around the globe in various equity markets, whether it's emerging markets, US equities, Europe, Asia, etc. And when you do that, there's no way around taking FX risk. So it can be hedged, but there's a cost to that hedge as well. So
yeah, and that's just the diversification factor that we certainly want to have. Correct.
Yeah, exactly.
Absolutely. Okay. Moving on, let's just look at where things are. Again, as Paul mentioned, these are just prices as opposed to all in. But one thing we do want to look at, and something that we track, just to get an idea of where balanced funds, Mauer is a 5-star Morningstar rated fund, so we think it's a pretty well managed fund, but we do try to track it to give us perspective as to a benchmark to a degree to just let us know how we're performing relative. So amongst all of these asset classes, Mauer at the end of the month was up about 1.6%. Just to give you an idea of a good balanced fund, and to compare, I mean, it's about a 60-40 mix as well. But I think, Paul, most of our clients will find that their portfolios are up anywhere from 2 to almost 5% over the course of the year so far. So I think
and
that we'll talk about that a little bit further along, but there's some good things that are going on in our portfolios, especially in the tactical model.
Yeah, I would just say have a look at your portfolio. You'll find it should be, depending on how you're invested with High Rock, and when you joined us, but it should be up on a relative basis substantially more than any balanced fund out there.
Yeah, and that just leads us to another conversation too, and for anybody who's wants to have a conversation specifically about what their portfolio is doing and why, we're always available. So we want to make sure that you're contacting us to have that conversation, because we're here for that very reason. And again, there's the US dollar or the Canadian dollar relative to the US dollar over the course of the year, and we can all see that it has strengthened considerably. Paul?
Yeah, no further comment. I mean, it's a lot of it has come through April and May, but and last year, of course. So no other comment on that.
A great deal of this has to do with the commodities markets that had been improving significantly, and as you've mentioned in the past, Canada is considered still a commodity-based country, and from an international perspective, that the increase in commodity prices will generally draw Canadian or investors to Canada and buyers of Canadian dollars.
Yeah, for sure. And the price of oil now getting up over the past few days, $68 a barrel WTI, is definitely driving some of that. Good point, Scott.
Yeah. Again, as always, our focus is based on long-term planning, and we always want to be making sure that we're considering the long term. And when we say long term, we're talking 10, 20, some people have 30 or 40 more years of investing and need to invest. So we look at short-term moves in markets, but we also always want to be keeping the long term in the backs of our minds. We always hope for the best, but we do have to consider that we manage risk first, so we have to consider the potential downsides. We know that generally equity markets have been bubbly in price. We do know also, though, that some of the high flying situations have been rolling over a little bit. Paul, any comments about Amazon, Tesla, the ARK Innovation Fund, even Bitcoin are all well off their highs?
Yeah, I think one thing to note, and this is just year to date, I assume, right, Scott?
Yes.
Yeah, year to date. So Amazon and those so-called FANG stocks, Facebook, Apple, Amazon, Netflix, Microsoft, Google, at one point, and I don't know what it is today, but at one point they were roughly 20 to 22% of the entire market cap of the S&P 500. Now, as I said, I don't know exactly what they are today, but I assume they're still around that level. But when you look at Amazon, and probably as of today, it's probably down 2% year to date. It's down 1% today alone. I think it was down 1% yesterday, year to date. So it's probably down around 2%. Like when the generals of the market start not performing, that's not a very good sign for the overall market if they're that big a component in the market. So that's something that we need to keep our eye on, and as we look at the overall macro market, that's going to be really important. So I think it's important to look at Amazon, and with regards to some of these other things, I mean, ARK is. I think I read something. There were several ARK funds, but she manages like $60 billion now, and all these various disruptor and innovation funds But when she's constantly on CNBC promoting her funds, and I think I read that like something like 70% of her holdings don't have any cash flow. Well, you're buying a lot of hope when you're doing that. And if you go down to the bottom right chart in Bitcoin, much the same. It most certainly, if you look at that chart, it is extremely volatile. It is not a replacement for cash. And it's, I understand the reasoning behind Bitcoin, but which we all do, which is fiat currencies are you're losing, there's a lot of erosion of value in fiat currencies because governments around the world, or certainly in Western democracies, are running massive deficits and they're basically devaluing the currency. And that's why asset prices are going up the way they have it's gone nuclear the past 15 months since COVID erupted. So I understand the reasoning for Bitcoin, but the problem with Bitcoin is obviously there's no cash flow, but there's nothing underneath it. There's no base value to Bitcoin, whereas gold and silver, roughly 75% of gold is used in jewelry consumption. Silver is a metal that's used in batteries for electric vehicles through to phones, etc. It's a industrial metal, so there's still use to gold and silver, although they don't pay you a dividend, obviously, or income. And Tesla is Tesla. I mean, everybody kind of knows it, but I would just leave that. Those are my comments, and certainly those 4 charts. But I'd watch Amazon. If the big market, the mega cap company that we all love and use is no longer producing outsized returns, then we have to watch the overall market.
Excellent. Okay, thanks for that insight. What's exciting us? Well, our models of, especially our tactical strategies, have been doing quite well, and even our fixed income strategy has mitigated significantly. So, Paul, I'm just going to turn it over to you and let you talk a little bit about those things.
Yeah, fixed income. We'll start with that. Although it's not at the top of the page, but you just mentioned it, Scott. I mean, we've been underinvested in interest rate risk, which is government bonds and investment grade bonds, to a pretty decent sized degree. It's probably going to, for the average client, going to work out to about 6% of your portfolio has been underinvested in interest rate risk. And interest rates have gone up pretty substantially over the past a few months here. And I'll tell you, not just the Mauer fund, but any balanced fund out there, you peel back the layers of the onion and look at it, and the attribution analysis would show you that they're just jam-packed full of interest rate risk. They own government bonds, provincial bonds, Canada mortgage bonds, etc. They're all interest rate risk. So when interest rates go up, that really affects your performance. So at High Rock, we've been underinvested a fair bit in interest rate risk. We've been overinvested and still slightly are. Maybe we're now flat on high yield, which have done very well. So that dichotomy between interest rate risk and credit risk, and high yield being credit risk, is really helped us. And then the 4th component in our fixed income model is preferred shares. We've been at our model weight in preferred shares, and we own the right type of preferred shares, so they've really helped. These are rate resets of the kind we mentioned in the last call, the kind of preferred shares that actually improve as interest rates rise. So that's been a pretty good thing. We are actually looking to add to one of them, but we've got a bit in below the market, so we haven't done so yet. So our fixed income has actually performed pretty well just by design. And then, Scott, maybe we can move. We really haven't done anything in the global equity model. We've gone through our view on valuation. So maybe we could go through a few slides in the tactical model, because I think that's where we've really outperformed and shone over the past couple months here. And certainly,
well, I'm gonna say outperformed and outshone, but I think you've knocked the ball out of the park to a degree. So I think that you're being a little modest. But anyway, let you carry on.
I'll let you say it, not me, but thank you. So, and unfortunately, three unfortunate problems with this first chart. Number one is these Atlantic Power. So we owned, you can see in the text box, the company was taken private in mid-January of 2021. So this does go back, it's not over the past month. but the press were trading around $17, but they were just great low volatility yield for our portfolios. Now, that was a pretty substantial premium. They paid $22, and the reason why we put this chart in is because it was just taken out at the end of May. So that was a substantial premium that the private equity company that bought Atlantic Power paid us. They also, and I don't have a chart on it because it's been stripped out of Bloomberg, but we also own these senior notes in our high yield, or pardon me, in our fixed income component within high yield. And those were trading around $92 before the takeout, and they took them out at 106.33. So that has all come out of our portfolios as of last week. Now that did put us up cash, but that's again, an attribution analysis is part of the reason year to date why we have done well. Now the bad part of that is we need to replace some of that yield, and it's becoming increasingly more difficult to do so. So we will continue to look for opportunities and low ball, under-followed, out of the way sort of situations like this Atlantic Power was. So maybe move on to the next one. Superior Plus. So we've talked about this one before. We bought this on February 11th at $12.91, I think was our average cost. And there's been, and I probably could have put up a slightly different chart, but there's been a large German strategic buyer of the stock, and they're up now as of this past Monday. Today is Thursday, June 3rd. They are up to just under 18% as of last Friday, I should say, which would have been the 28th, I think, of May. They're up to just under 18% of owning the stock. They can get up to 19.9% without making a formal offer for the company, and it gets kind of confusing from there. So we did sell 25% at $14.93. The stock has got up to around 15.5 at high and is sitting around 15.25 right now. And I would warn our listeners that it is fully valued, and that's why we sold some just beneath $15. This is more of a technical play on what this German entity may or may not do with Superior Plus. I don't know if they want to buy the whole thing or they just want to have a roughly 20% investment in it. I don't know, but it's pretty fully valued. If it was taken out, it might be taken out at $17, $18. I don't imagine it's going to be a whole bunch more than that. But in the meantime, on our cost base, it was paying us more than 5.25 dividend yield. It's a very stable rural propane delivery business. It's a pure play in propane delivery now, all through North America. That is effectively what the business is. They used to have a chemical manufacturing, industrial chemical manufacturing business, which they just sold a few months ago. And they also had a building materials business, which they sold as well. So still like it. We're going to hang on to it. I don't have a real level on the balance to sell any yet because it is kind of fully valued. We'll just play this technical picture for now on the flow. So maybe, and that obviously has added value to our portfolios, not enormous, but we have a decent sized position in it. Maybe the next one, Scott. Baytex. So this is obviously an interesting chart, and one we were able to take advantage of for, it's gone pretty well. You can see where we bought it on Feb 5th at $1.05 is our average cost. We actually bought it a couple times, but our average cost is $1.05 for certainly older existing clients. And we did sell it at 25% at $1.28. We still have a decent sized position, as you may notice in your portfolio, but you can also see what the stock has done. It got up to yesterday on Wednesday, June 2nd, it got up to 220, and it sold off. I must say, I should say, Scott, that it sold off pretty substantially yesterday, and that was with oil going higher, and it was on big volume. So it was not actually a very good day. So it sold off around 5%. On one day alone, down towards the 205 area, which is where it is today. And all of its competitors in the oil and gas space were up like somewhere up 4, 5, 6%. So that was a big differential. So I think it was just flow. I think it was one big seller coming out, but I still like this one. We've got an order up higher than 220 to sell another 25% of what we currently own. So we'll maintain our watch on that. But as you can see, the past couple of weeks, it really did ramp up like a hockey stick. So I would not be surprised to see a bit more of a pullback into the $1.95 type area. And then I think it'll reinvigorate with buyers. Oil is up. WTI is at 68 bucks a barrel. This company is going to produce over the next 5 years. It should produce roughly $1 billion of free cash flow, which is after all expenses, etc. And that will go towards paying down debt for certainly in the first 2 years. And then it eventually could become a dividend paying stock, which would be very interesting. So, that one is almost a double from us, so from where our adjusted cost base. So let's hope and pray it continues to move higher after a slight consolidation period. What's the next one, Scott? PCE, we owned a very small amount, but we added to it. Some might look at the chart and say, why didn't we add earlier? Well, so we didn't, but we bought it 58.15. It's up around 60.5 right now. When we bought this, it was yielding around, I think it was around 5.25% dividend yield. And part of the reasoning behind buying, adding to our BCE position was Rogers taking out Shaw. So you've just taken out another big, sorry, that was when we bought that, it was a 6.25% dividend yield. It's around 5.75 right now. So this is like, to me, this is with one competitor gone, and we picked out 6.25 dividend yield on a telco. I think this is still pretty darn good value, and it's really hard to replace yield in a portfolio right now. I'll just give you an example. So this is kind of a low vol yield play, in my opinion. The investment grade space, if we were to go buy a BCE bond, it's yielding, 1.5%, and we're taking some interest rate and duration risk. If we bought a high yield bond, in fact, one just came this morning, which we already own, Parkland Fuels. It was 3 3/8, 3 7/8 coupon or yield. It's tough to get upwards of 5, 6, 7% yield. So this is a good dividend grower over the past 5 years. I think the dividend has grown. I can't remember off the top of my head, but it's grown at least at a 5% annual rate. So we'll stick with this one. I think it's decent low vol yield replacement. And what else do we have here?
Just before we move on,
yep.
Just for some of our clients who don't necessarily understand all the lingo, low vol.
Low vol. Oh, sorry. Go ahead, Scott.
No. You carry on.
Oh, low volatility. So when I say low vol, I mean low volatility. I'm sorry for the short form. And volatility is simply how much a price moves over a period of time, on what percentage basis it's moving. So, what we talked about Atlantic Power Preferreds. I mean, they sat at $17 for a long period of time, paying us about 7.5% yield at that level. That's really nice. We don't have to worry about big price swings and get nervous when we see downdrafts in the price. And in fact, well, you can't really see the entire chart, but we don't want to see big valleys and big spikes when we're just trying to get yield. When we're just trying to get capital gains, it's not so bad. But when we're talking about yield, we would rather not have big volatility swings.
And that comes back to just our general risk management.
Right.
Yeah.
Enbridge. We didn't do anything on Enbridge. I just threw this chart in as another example of volatility, or pardon me, not volatility, but yield. Another way that we think it's a little bit, this is not BCE, this is a little bit of a play on energy, fossil fuel energy. When we bought this stock quite some time ago, it had about an 8.25 yield on it. Now it's down to around 7.15. So as the stock moves higher, obviously at that dividend payout ratio, it's a lower yield. But so we are collecting a pretty good coupon on this thing, and it is energy related. It's not as volatile as a Baytax, which is a exploration production company, but I just put this in there as an example of how we're trying to get some yield in the portfolio that we think is lower volatility. And we own a much smaller amount of Trans-Canada Pipeline or TC Pipeline. So when we combine the two, they're very similar businesses. When we combine the two, we've got a decent position in both of them. And these are levered entities, i.e. they run a fair bit of debt, but 90% of their revenue is contracted on pipelines. So it's a reasonably stable, or very stable cash flow business. What else? Yellow Media. So a couple of things about Yellow Media. Number one, we'll talk about the stock. We did add, everybody should have a full weight in this, and we actually even added to it, as you can see, just a couple of weeks ago at 13.25, and then it kind of ramped up. Now the reason most of our older existing clients, Scott, some will own this as low as $5, but most would probably own it with an adjusted cost base of $7 over the years. So as you can see, we're now trading just under $15 on this stock. So it's been roughly a double from most of our clients. But interestingly, over the past year, the company has now been paying a dividend. And the dividend is only around 4%. But here's why we added to the stock. Number one, you will notice in your portfolios as well on May 31st or June 1st, the company bought back its last piece of outstanding debt. At High Rock, our clients owned a first lien senior secured bond that was a phenomenal bond, low volatility, and a big coupon. I think it was 10.5, if I'm not mistaken. That bond was bought out by the company and retired entirely probably a year and a half ago. So that was sad to lose, but also, it's just the way it goes. So we ended up buying more of this bond, which was a subordinate bond. So it was beneath the capital structure of the senior secured bond. And we bought a lot of this bond. Now it was roughly at par or slightly above, but it was yielding us at an 8% coupon. So as of May 31st, June 1st, the company bought the entire 107 million back. Now we've been preparing for this due to fundamental analysis and knowing the cash flows of this business, which if anybody would want to talk about, you'd probably think Yellow Pages. Oh my God, those things are horrible and nobody uses them anymore, but it is turning into a digital business. So I know it pretty well and follow the cash flows on this thing, and it still spits out a lot of cash flow. So as they retired the senior secured bond, we bought more of it, the convertible bond. Now they just retired that. So we wanted to add to the stock because here's what I think is going to happen. They're going to, they just bumped up their dividend. So now it was under 3, now it's just over 4% yield. What they are going to do, I think, is continue to bump the dividend up. It could be a combination of these things. They could pay out a special dividend. This is how much cash flow this company spits out. And it's all, their earnings all convert to free cash flow. So they have a lot of discretionary ability. So they are going to increase the dividend, pay a special dividend, buy back stock. They have no restrictions on what they can do on any of those 3 items right there. And the fourth thing is there could be a private equity company that comes in and looks at the cash flow in this thing on a 5-year forward basis and just buy the company out. So it could be, as I said, any one or a combination of all those things. But there's so much cash flow behind this business. It is not growing. The cash flows are shrinking. So it has a very, very low multiple on it, which means that no one wants to pay a big multiple on a shrinking cash flow business. That's fine. You still know what the cash flows are. They're very, very predictable, steady cash flows. So I like this one. We do have an order in to sell above the market. I won't say what it is, to sell 25% of what we own. But I think this stock can gravitate up towards 18, possibly $20. And that may depend, or will depend rather, on how the CEO, who's done a phenomenal job, but how they continue to try and ramp up revenues and actually get some growth in this business, which would be phenomenal. That's it for that one. I think that might be the end of some of the highlights. And those are just highlights in our tactical model that we think helped, or we know helped produce our year-to-date returns. I would caution, obviously, as the bottom right in the slide says, past performance is not a guarantee of future returns. Number one. Number two, there is volatility. Any of these positions could go up or down substantially. So stick with us. We're trying to get over speed bumps, and hopefully we don't hit any major potholes in any of these. But there's always risk in investing in single name positions like these.
Well, I think what comes to light here is twofold, at least. One is that when you look at markets in general and how markets perform in general, they're all relatively correlated to each other to a degree in the equity world, except what you've done is gone behind the scenes, done your homework, and found some opportunities that are actually doing better than the market. And these situations take time to develop. And what you've been able to do is, and what we are, is quite patient with how they develop and how we participate. But it does add value to all of our client portfolios as we participate in these particular situations. At times, we may not perform at or with general markets, but then when general markets aren't performing, these alternative style strategies are able to help us outperform. And it all works back to us over the long term, providing very good, as you say, low volatility or risk adjusted returns for our clients so that they can sleep at night and still get long-term good performance.
Scott, I'm just going to add one more thing too, and that's what you just said for sure. That's something we always strive for. But just as a note to our clients as well, our cash positions have gone up as of June 1st. And some of that is the Atlantic Power preferred shares, the Atlantic Power bonds, and then the Yellow Media bond that was taken out. So all three of those positions, and the Yellow Media bond, we had a pretty good sized weight in. So all three of those positions have been taken out of our portfolios effectively by the end of the month. So we are long more cash or holding more cash in our portfolios right now. So be patient. We're going to be patient. There's not a whole bunch that we really want to buy right now. So we're just going to, hopefully, the old adage, sell in May and go away, comes to fruition this year, and we may see some weakness. But until then, we will be disciplined with this cash.
Well, cash can be defensive, and for us, as we see overpriced assets, we don't mind that. And when asset prices come down to more realistic levels, we'll have the cash to take advantage of those lower prices. I think that's just a great strategy, and that's why we like having a more tactical strategy at times, and we think it will benefit everybody over longer periods of time. Anyway, I don't want to push any longer here, but I know Diane, you have been working. Diane worked very, very diligently through tax time, and we hope that everybody was able to file their taxes on time, and we're going to definitely be hopefully a little more streamlined next year, and as we understand and learn what people need, we want to be a little bit more proactive that way. So if anybody has any requests to get tax information in advance, or that they would like to get certain information, they happily will look after that. So just please let us know. So Diane did work very hard on that. Now she's got other projects that we're going to work on, and Diane's just going to fill you in on a couple of things.
Thank you, Scott. Just wanted to say hello to everyone, and just wanted to let you know there's a couple of administrative and compliance things coming along. The CSA, which is the Canadian Securities Administrators, sort of at the top of the regulatory chain, have come out with some new regulations and some additional regulations around some of the know your client information. These are called the client focused reforms, and the first of which will be required to be distributed by the end of this month, and that will be a disclosure of conflicts of interest. Conflicts of interest has always been part of the policy and procedures manual for High Rock, but at this point there will be additional disclosure to the client, and it will be setting out what are possible or perceived conflicts of interest, what conflicts of interest may be at this point, and how High Rock deals with them, and what policies and procedures we have in place in order to not have any issues with those conflicts. And just another, another way of being more transparent for you, the client. In addition, through the year, we will have additional know your client, know your product, and other updates that will have to be dealt with by December 31st, but that's for another time. And I also, on an administrative note, wanted to let you know that next week I will begin sending out the requests for portfolio reviews, and we can start setting up some of the appointments with Paul and Scott to go over the portfolios and to discuss any changes that may have occurred since your last meeting. And that's about it for me. Thank you.
Yeah, thanks, Diane. Thanks for all your hard work behind the scenes. You do a great job. All right, well, that's going to be it. It was a bit of a long one, but I think it's important that we all that we share what's going on behind the scenes with you, our clients, and we'd like to say thank you for taking the time, the extra time to be with us today. And on behalf of Diane and Paul, we wish you a great month of June, and we'll be back at the beginning of July, and we'll by then be well into summer, so we may lose a little bit of listenership as we go through the summer, but here's hoping that we're all able to be get out of lockdown and get outdoors and maybe have a little bit more enjoyable summer going forward. But until next time, y'all take care.